right, so you should see that little notification. You'll have to hit accept. I'm going to share my screen with you guys in just a moment, but I'm sure you guys know, because you are here today, we're going to be talking about financing. We have Allie Ganley with us from Movement Mortgage. I'll give her kind of a formal introduction in just a few moments, but the purpose of today is kind of all encompassing. We really design these classes as a starting point for you in your career, but it's also nice to have a point of reference for a contact, so that you can ask any questions that you have relating to financing. So we're going to go over the little nitty-gritty details. We're going to cover the different types of loan structures that exist and common terms and questions that we get from clients. I'm going to let Allie kind of explain a lot of this and how she works with the client. We'll also do a good amount of scripting. I know that people hate that term, but in reality, it's just getting used to saying things in a way that is efficient and clear and communicating with the client. And these are conversations that we have regularly. So just know that this class is for you guys. I have a general structure for it, but at any point, if you have some questions about what we're talking about, feel free to raise your hand or drop it in the chat. I will be asking some questions, so please participate. There's nothing worse than just hearing ourselves talk endlessly. And like I said, this class is for you. So I don't mind a silence. I'm going to wait until you kind of chime in. So as I ask questions, please jump in. I'm going to tell you how I script things, but I'd love to hear from you how you do it as well. So welcome. Let me go ahead and share my screen and we'll get going here today. Obviously, you are here for the financing class. We're going to cover a ton. Thank you, Allie, for joining us. And thank you to everyone that's hopping on today. In my experience, I know a few of you have shared some things that you hope to learn, and we'll definitely cover all of that. But as we get started real quick, I wanted to just do a quick show of hands to see how many people here have personally gotten a mortgage already, like in your personal life. Taylor, Greg, who else am I missing? Tamika, awesome. How was that process? Thomas, thanks. How was that process for you guys? Okay. Taylor says it looked like it was pretty good. It's hard for me to see all of you guys at once, so feel free to unmute yourself so I'm not missing anyone.
Allie makes things very easy, so.
Love to hear that. Sounds like kind of an outlier, but that's why we have stuff like this, so you can meet the right people and make it nice and simple. Yes, anyone else want to share?
I've had good.
Really, Joe, it sounded like you didn't quite enjoy yours as much, and it sounded like you had a little room for improvement. What was one of the hardest parts of that process, do you feel?
I guess for me, it was the long-term experience. I just felt like the bank was not, the bank I was working with was not approachable or available. And my experience of paying down my mortgage was drastically different than the proposal that they gave me. So I guess I will never know what happened to my first 5 years of mortgage payments, but
Oh, no.
That's okay. This is my perception of the experience.
Well, it's understandable to have a lot of questions and not understand it fully. And also, unfortunately, not being reachable easily is one of the common feedbacks we hear from people about certain lending experiences, unfortunately. Cool. Tamika or Helena, do you want to share?
Yeah, mine was really easy. Our mortgage is with State Employee Credit Union, and I went to school with a lot of the girls there. So anytime I had any questions, they were on it. Even now, like now that I'm working in real estate, there's a girl still there or a rep still there. If I need anything, she'll get me what she can. I know sometimes it's really hard to get information from them, but she'll help out as much as she can. So it was pretty easy.
Having a good point of contact makes all the difference. Awesome. Thanks for sharing, you guys. Well, that's a good starting point because we're going to cover a lot of that today. Kind of our next question, putting on our realtor hat, kind of taking a step away from the personal experience. At what point in the process are you asking your clients about financing?
The initial buyer consultation.
Yes, absolutely.
Yeah, I would talk to them on that first meeting and just say, how are you? You know, what's your price point? How did you come up with that? Are you paying cash or do you need help finding a good lender?
Oh my goodness, you took the words out of my mouth, Thomas. That is exactly how I script it as well. I'll kind of back up for a second, but yes, that's exactly why we're asking this. In essence, as soon as we are having a true conversation about financing and getting to know our clients, or getting to know them and having any conversations about the process more in depth, we're asking about financing for so many reasons. One, because none of this can happen without the money, but also because we're not here to just open doors. We're here to get people to the finish line. And so without motivation and financial ability, that's not going to be happening. And so to Thomas's point, that's one of the main ways that I ask that question. And it sounds like a lot of other people do as well, just kind of starting that conversation with getting an understanding of their price point, getting an understanding of how they came to that, and asking, will you be paying cash or do you plan on getting a mortgage? Or to the way that Thomas said it, can I make an introduction to a lender for you? How else are you guys having this conversation with people? Or what is that question that you feel is kind of your snowball into that introduction? I like this question because I feel like it doesn't assume things of our clients. I'm not assuming that you don't have the money for this. I'm just assuming that I don't know which route you're taking for it. And so if you want to be paying cash, please know I am all about that. Allie, I love you. But if they're going to pay cash, then I'm all about it. But if they need to get a mortgage, then obviously I'll make a good introduction. But the sooner we can ask, then the sooner that prepares us for a number of things. One, understanding their timeline and what it's going to take to get them there. Also understanding what that conversation is going to look like in terms of setting expectations for deposits and scripting what the due diligence process is like, and any potential concerns that I might have or situations we might run into that I want to go ahead and get ahead of or prepare and make sure I've had kind of the same conversation a few times with them. And so from the agent side of things, this comes into play for a number of reasons. One, like I mentioned on the front end, between you and me, I'm not here to open the door. I'm not here to just show you homes. I'm here to get you to the finish line. And so if we're going to see homes, to Taylor's point, Thomas's point, as soon as we can start to have a true conversation with people, I want to be understanding what their financial situation is and going ahead to set them up for success. Because really and truly, you know, I don't mind showing one home, but as soon as it heads into two, and as soon as we start to become more serious, I want to make sure that we had either a proof of funds or an approval letter in hand, because if we walk into the right house, I don't want to disappoint them. I want to know that if needed, we can go ahead and write an offer on that. And we want to make sure they're ready. I also use this to get an understanding of not only what their price point is, in terms of what they want to be spending and what they qualify for, but also what that price point means in terms of how we need to be shopping. If we're looking at the COVID timeline and how things were selling in 4 hours sight unseen, you know, if a buyer has a price point of $600K, we were shopping at 500 or under. But if they're pre-qualified now for that same amount, we might be shopping a lot closer to that 600 mark, or maybe even slightly above if things start to cool down. So understanding what they're qualified for will help us structure all of that. And I always set the expectation with my clients that regardless, the lower the better. Please know I'm not here to sell you at the top of your budget, but I do need to understand what we're working with. That's also going to help me understand the loan structure and potential deposits, their cash on hand, and like I said, how to script different things. And I think it's a really common misconception, especially with people that we know very well, that we're going to know all of their financial information. When we start to head into the financing conversation, it can be a little intimidating for some people, especially if they're good friends of ours, because they don't want us to know how much money they make, or they don't want us to know what their credit score is. And I don't know any of that really and truly. And it's actually perfect that I don't know that, because it's a great way for us to streamline that conversation into an introduction with a lender. I know a few people had raised their hands. Billy Joe, did you have something you wanted to ask? Or anyone that has their hand raised?
Hey, I'm sorry. I unfortunately just was trying to lower it. I accidentally raised it.
Okay, sounds good.
But I will comment, since you know I always will.
Please.
I can see how this would be a tough conversation regardless. So I appreciate your scripting right away, how you bring it up, making it all about them, and let's not waste time looking at homes that ultimately, it's like looking at a magazine. You're not going to be able to afford this home anyway. So
Right.
really trying to figure out what they would actually be able to make an offer on.
Right. Absolutely. And normally that script will work. Occasionally it's not quite enough. And so I will often kind of same type of conversation I have with buyer agency. I normally will then just say, all right, well, really and truly, when we're walking in the door, I want to make sure that if this is the house for you, that we can go ahead and write an offer, which means I need to be doing as much as I can to get your file ready. So that when that time does come, you and I are both in a position where we can jump as quickly as possible. So I'm going to go ahead and send you some documents on my end, including buyer agency that just formally hires me to work for you. And then on your end, why don't you go ahead and talk to the lender? I need a copy of your pre-approval in my file before we can proceed. And just kind of straightforward and to the point, that is my next step. You can't really argue with that. Taylor said, I have buyer rules and email templates that I won't show a house without approval. That is very true. And I would like to thank you, Taylor, for copying me on one of the introductions you've had with a client, because Taylor is very good about setting expectations. Like, these are your rules as a buyer, talking about how much time in advance you need notice for a showing. And if they're going to new construction, to make sure they let you know so they can have cards, but also exactly that, what their timeline is for signing different things. No one's going to do all of this for us. We can only set these boundaries for ourselves and set the expectation with people and how we are going to work with them. So great job. Work those scripts in. It's also great for us to ask this question on the client side, because it helps show the seriousness to them. And for the same reasons, they want to know how much they can afford. They want to know how much they can shop at. And realistically, they're trying to get a feel for financing, both in the long run and in the short run. So what does that mean in terms of their monthly payment? What does it mean in terms of how much they're going to be bringing to closing? And it's actually perfect that we don't know the answer to these questions. Just like we were talking about at the front end of this call, we actually can use all of that as a great way to pass the client off for an introduction with the lender. That's a great question. I don't know. Why don't we get you speaking with a lender? I can get a very general idea, ballpark speaking, of what you might be able to get for a given house, or what that might yield in terms of your monthly payment, but I don't truly know. So let me connect you with a lender. They're going to be able to answer any questions that you have. They're going to be able to tell you what you truly qualify for. If there's anything we need to do, whether to make it a situation where you have a better rate, or whether we need to do a few things before you truly get qualified, whatever the case may be, let's get you talking to a lender so we can have those questions answered for you. And it makes for a very seamless introduction. Yeah, I would love to show that last slide. I don't mind not knowing the answer. I think there's great strength in recognizing what you do not know. And just saying, if we're a professional, then we truly do have all of the resources. It doesn't mean that we necessarily have all the answers. So one thing real quick as well, I know we're jumping back and forth to slides. I will provide a copy of the recording and a copy of the slides after class as well. So feel free to jot stuff down, but just know you don't have to get all of it in one go, because I'll send it later as well. And so on that note, one of the main reasons we want to get all of this in order is we can jump in time. If there's an offer deadline, if it really is the perfect house and they've been looking forever, you never know when the motivation will strike and when that person will move up from a B to an instant A and be ready to write an offer. But one of the main reasons it's really important for us to understand financing is because a lot of the time, 9 times out of 10, if a deal falls through, a lot of the time it has to do with financing. And I would like to proactively say that a lot of the time it doesn't necessarily have to do with that given lender. It can have to do with how much we've done on the front end to get them ready. And it can be based on the lender if it's not the right situation, but we need to make sure that we're setting them up for success and avoiding as much as we can on the front end. So if there's anything we can do to really get our clients ready, or if there's anything we need to work through, then it's nice to do that on the front end. Derek, you got a question for us, or you have a thought?
Yeah, I think Tamika had her hand up too, if she wants to go first, but I just wanted to mention something quick, just that it's not necessarily the lender's fault, but there's so many regulations on the lenders that I think if a lot of clients might already know that, or probably already know that, but some first-time clients, they may not realize that there's so many regulations on the lender. It's not the lender being a pain. I know the first house we bought here, I was like, I don't want to work with them. I don't want to deal with them, but it's not them. It's just the regulations that were put on them.
Yeah, absolutely. It's nice to set those expectations with our clients in terms of what they can expect out of that conversation and what they're going to be providing. And we'll talk about that in just a moment, but yes, absolutely. It's not their fault. But to that point, it really does depend on having a really good lender. That can make a big difference, because when it comes down to it, really and truly, the reason we work with a preferred vendor of any type, but especially a lender, is for control and communication. And I don't mean that in a selfish way as an agent, but I mean that in terms of protecting our clients. They're going to have deposits that are non-refundable. They're putting up a lot of money for this situation. It's something they worked incredibly hard for. And we want to make sure we are getting them to the finish line. And so we need to be making sure that we're staying ahead of that when it comes to the lender. We need to make sure that our clients understand what they're getting into. We need to make sure that they understand what that looks like in the long run, what it looks like in the short run. And I really, when I'm making that introduction to the lender with my client, I always kind of use descriptive. The reason I work with this lender is for a number of reasons. First and foremost, their whole goal is to be a resource to you, just like that's my whole goal. We're not here to sell you something. My entire purpose here is to make sure you understand what all of your options are and that all of your questions are answered. And that's why I work with this lender, because they treat it with that same regard. More than that, though, I also know that they are available. To Billy Joe's point, depending on the lender, it can be very hard to get a hold of them. To Tamika's point, sometimes working with a credit union, they can be very hard to get a hold of. If you have the inside scoop, not as much, but that can be hard to get. So having someone that will answer the phone when you need them, we are in a situation where there are very important deadlines that, if they are not met, there's other deposits or things like that can be at risk. And so we need to make sure that the person that we are in relationship with in this contract is answering when we need them. And more than that, they are also local. All of the real estate contracts that exist are specific to a given state. And so having a lender that is designated and local in this state means that they are here to guide you fully and that they fully understand that contract. And we're setting you up for success. So why don't I make that introduction? I'll give Allie a call and just give her a little rundown on your situation, what you're looking for, and then I'll send a group text and you guys go ahead and connect as soon as you have time. And then give me a call once you've done that so we can all be on the same page. And in my mind, I'm knowing that as soon as I've made that introduction with Allie, then she's also going to be giving me a call to catch me up to speed. So find a script that works for you and use it. I know Thomas used one that's basically the same as mine. I use the same. Does anyone else have an introduction that they use for explaining their lender and why it's amazing? Taylor, I see you nodding your head. Tell us, I know you're one of Allie's biggest cheerleaders, understandably. So tell us how you do your magic, make that introduction.
So a lot of it is like on that initial call, I used to offer like multiple lenders, but then I found out like Allie and I handle our business very similarly. So if a client wants to work with me, they're going to be just fine working with her because we have similar styles. So it makes it like very easy. So when we're doing that initial call, it's like, hey, okay, you haven't talked to anyone, or if you have, let me still make this introduction. And so I always say she's our go-to. She's handled about 97% of our clients' transactions. She's great in communication. Basically, I make it seem like we're a team and we work together on things. Right after that call, I send an intro email between the client and Allie. Allie bounces off. They set up a time to call. I'm extremely looped in, and I send like a follow-up email to just the client that basically says, your next step is getting pre-approved. We don't start the house process until we know, because like you said earlier, we don't want them looking at stuff outside their means, because that just makes the entire process more difficult, because then they get their hopes up and stuff like that. So then once they're pre-approved, Allie sends an email to me and them letting us know. And then we send another email that's like, congrats on being pre-approved. Here's a reminder of what we went over, and here's our next step. So it's like we're working together on this entire thing. And then we also CC Allie on all of our offers, just to show even that listing agent that we're working together on this. She knows what we're submitting, because that pre-approval is adjusted for each offer that we're submitting.
I love that. Thank you for sharing all of that. And a number of things. One, to your point, having a similar work style and workflow. I am all about sending, touching base at each point in the process so everyone knows what's going on, and following up with an email so we have it in writing and that they have something to reference back. We fully recognize that we do this every day, but it's not an everyday decision for our clients. And so things that seem very easy to understand to us, it would be very understandable that they don't necessarily take that time to absorb it. It might take a number of times, and even by the end of it, they're likely going to feel like they have no idea what just happened. It's quite a rush, and it's hard to kind of take a second. And so having something that they can refer back to in writing is of great value. And having a lender that does the same thing, it just makes the whole process a lot easier. Also, I love that you mentioned saying congratulations. Brian's a big believer in this as well, but celebrating those little victories. This whole process can be overwhelming, and it can seem like obviously the only part that matters is like the closing date, but there's so much in between that deserves to be celebrated. And you celebrating that makes people feel special and helps with those referrals in the long run. Not that that's all that we're here for, but really and truly it can make a difference. And so celebrating once they've been qualified, celebrating once they've gotten through due diligence, and truly making that a celebration. Everyone has their own process, but I know Brian had mentioned when he was in production, he would make a habit of getting people's work addresses. And then that way, after due diligence was over, he could send them flowers or something mailed to the office that other people would not only congratulate this person, but ask what's going on and what are the flowers for. And that can give us an opportunity to get referrals as well. But, kind of in addition to that, this is a life decision people are making, and often people have worked very hard to get to the point where they can afford it, and that they are able to be qualified, and that they can move along in this process. And so join them in that celebration. That's not just a benchmark that we're meeting. That's a huge life accomplishment that people have worked very hard for. So thank you for saying that. And then I love the idea of copying people on the offers. That really does show that. And it's a nice little step up. I've never done that. So good practice to add. Thank you for sharing. So
yeah, I always add in after she CCs me on that offer that, the buyers are super qualified and we expect a smooth closing, just to chime in that like my 2 cents that everything's going to be fine, and just, it helps, I think.
Oh my gosh.
Especially being local too.
Right.
And agents will immediately respond to Allie and be like, thank you for your added confidence. So it just, I feel like, makes us look stronger.
Yeah.
And it further proves that your lender is very available and responsive. I'm a big believer that the way you take care of the things that you can't see, or the little things, says a lot about how you're going to handle the rest of a given process. And so I'm sure that speaks volumes, because quite literally she is doing it right after it's been sent. Awesome. Well, that's a perfect way for us to make that introduction. Welcome. This is Allie Ganley. She is a senior loan officer with Movement Mortgage. She has been partnered with a number of our agents, and we're so happy to have you as a true partner with Choice now. Allie is amazing at what she does. Like I said, she really does treat this in the same way that we do. She is here to be a resource, which is why she is on so many of our Choice chats and calls like this, because she recognizes that it's not just about the clients. It's also about taking care of the agents and making sure that this entire relationship is seamless. So today we're going to cover a lot. We're going to talk about the different types of loan products. We're going to talk about interest rates currently. We're going to talk about some of the common questions we get from clients and all that fun stuff. We're going to kind of do a little duo, but before I get into that, I just want to kind of pass it off to you, Allie, say thank you so much for being here. And I would love, if you don't mind, giving us a little introduction and a little spiel about how you got to be in the mortgage industry and what you love about what you do.
Well, thank you. Yeah, I kind of stumbled upon the mortgage world. I worked at State Employees Credit Union for 13 years and ended my last 7 years there in the mortgage department. And so kind of just transitioned in the outside world, and landed at Movement, which I love. Not only or do we have a quick process, but like our operations team in the back makes everything run so smoothly. And that's like my first and foremost, most important thing is just to make everything go smooth, good communication. I think that whether somebody's bought a house 20 times or this is their first time, I think that, making sure that they know what's going on step by step is super important. So, just doing that with, you guys as the agents and the buyers as well. I think that's just how I roll. So
Awesome. Well, thank you. And I actually didn't know that about state employees. So we've got a lot of questions to ask you about that as well. But having a good back end makes all the difference, because you can have an amazing relationship with a lender and, you guys certainly pass the torch at a certain point. And so you can have an amazing experience with a lender. And then if their back end people or systems are not there, then it can really drop off. So knowing that Allie is not only amazing what she does, but has an amazing team behind her makes that introduction even more seamless. And we can feel really confident in making that pass off. So thanks for being on here today. So on that note, kind of to start things off, I would love to hear from you what that introduction looks like once we get a contract.
Before we even get a contract, we'll do an initial call, basically just kind of getting the general background of what they're looking for, what their timeline is, that sort of thing. Definitely, like this slide says, step one, promote you guys as agents. I could work with an agent the first time or 20 times, and I'm still saying you're in great hands with so-and-so, and just giving them that confidence. Then I'll walk them through how to submit an application online, things to expect as they go along through that. And then once that application does come through, I'll review it within 24 hours, and then we'll get on another call or Zoom, kind of go over more of the details as far as numbers and everything. And that way they understand everything from all the closing costs, not just the lender fees, but like attorney fees and taxes and insurance and all of that, just so they have the whole big overview, and give them that initial pre-approval letter to start looking for homes. But beyond that, once they actually go look for homes, they can send me the actual address and I can give them an even more accurate quote as far as those estimates, so they have a better idea as far as if they and when they want to put an offer in.
And how long does that process normally take? I know it can really depend on if someone needs to do credit repair or something like that, but can you give us a few examples?
Yeah, if they're pre-approved right away, they don't have to do anything as far as to get to that point. They could be shopping and putting an offer on a house the very next day, and we'd be, ready to go. But it's all about everybody's timeline, and sometimes it's super quick, and sometimes it's, months. Like I have a couple that I talked to already that they're not looking until the fall. So, but they want to be prepared and know exactly that they are ready to go, even though it might be a year off.
Perfect. Lenders are very much like ourselves as real estate agents. We can be working with someone that we just got as a client yesterday and they're going under contract this weekend, or it could be someone that we are nurturing for months and months. But regardless, that's a great opportunity to build value and build a relationship. And, none of us are truly ready tomorrow. It might just have been that we waited to reach out to an agent until then. So having a lender that's committed to helping people get there makes a big difference as well, because people have worked really hard and they want to make sure they understand everything. Awesome. Thank you, Allie. Mm-hmm. So on that note, can you explain to us the difference between a pre-qualification and a pre-approval?
Yep. So 9 out of 10 times we're going to do a pre-approval. It just makes more sense because a pre-qual, you wouldn't look at actual credit reports. It would all be just stated information, nothing to kind of back up what they're saying, which, sometimes if they are looking months and months down the road, maybe that's just makes more sense for them just to get an idea of everything right now. But definitely before you either shop for homes in general, go out there and shop, you want a pre-approval, or if maybe you'll let them take you out a couple times, but then if they're ready to put in an offer, they got to have that pre-approval, because we want to make sure the credit is good and qualifies for the mortgage loan, and that their income backs up what they're stating.
Absolutely. And I know these terms can be used interchangeably a lot. I feel like a few years ago, it was a lot more clear on the difference between the two. But I feel like now they get tossed around a good bit. And so it's really important that regardless, we as agents understand the difference, especially when we're going to present an offer. And I guess that's even more so why it's important to have a relationship where you can copy Allie on it in your offer, so that they can provide an extra level of strength and assurance to that person. But part of the misunderstanding here is the level of commitment and the level of auditing and the amount of information received. So if you are speaking with a client, they say, oh yeah, I've got a pre-approval or pre-qualification, you can say, oh, wonderful, can you send that over to me? And just kind of put eyes on it. But the closer we can be to a full approval, the more documentation they can get over to the lender, and the more we can kind of check those boxes on the front end, then the more we're setting them up for success. Because what we don't want to have happen is rush through this, have just a pre-qualification, just a few conversations on it, and then realize once we're under contract that as they're sending in documentation, they're not as approved as what we thought. And then it's kind of too late. So getting a full approval on the front end is very important. On that note, I know someone had mentioned it in the chat. Carmenisa, I think, is the one that mentioned it. How long is the pre-approval good for? Is it 60 or 90 days?
Yeah, the letter
Oh,
itself says it expires in 60 days after we do it. I'll send that initial pre-approval letter once they are pre-approved, but usually we'll update that and make it so the date is updated and the amount is exact based on what the actual offer is, just so it's more personalized that way. But their credit expires after 4 months. So after we pull credit initially, they'll have to close in between that time, or if they go after that, then we'll obviously have to re-pull credit if they're closing after that 4-month time period.
Yeah. And kind of to the point of the conversation you were mentioning earlier about sometimes it can be months and months, just like us as an agent, it's nice to make that introduction and to start this conversation well in advance, mainly because of financing. You can be ready to purchase at the end of this year, but let's make sure we have all of our ducks in a row. Let's get you talking with the lender. She'll decide whether it's realistic or not for us to pull credit. We might wait on that and simply get you a pre-qualification on the front end. Maybe we'll wait for a full approval, but I want to make sure we're having a conversation with the lender so that we understand if there is anything we need to do to get you ready to be qualified, that we know it now, because there's nothing worse than getting to October when you want to be shopping and realizing that we've got some credit repair to do, or realizing that it's going to take a lot more cash at closing than what we have in our pockets. And if we had that amount of time to recognize we should be really designating and working towards saving, or that we should be communicating with the lender on the front end about our credit work, we'd much rather know, so we have as much time in advance to prepare. And so us talking about getting in front of our clients and making that introduction as soon as possible is not just a selfish act. It's not us trying to push them up further in our own timeline. It really is about setting them up for success and making sure we have enough time for the whole process. Kasha, I know it looked like you had raised your hand at one point earlier. Did you have a question for us?
You just answered it.
Oh, okay, cool.
Thank you.
Yeah. And I guess in that situation, Allie, would you recommend that credit is pulled in that early situation, or how would you advise the client if they're?
I think it depends on how the conversation goes, that initial conversation. There's some people that are super confident their credit is stellar and that, they don't have very much debt, that sort of thing. And usually those people, they really do know what's going on. They might not know the exact score, but they know like what they have. Some people aren't sure about where their credit is. And so that would be a good time to pull credit and look at it and see what needs to be improved, if anything, because the higher your credit score, the better your interest rate's going to be. So if we have time to get you there, then let's do that, because it's not going to hurt you by pulling credit and improving it along the way. So
Yeah. And I don't think I have a slide on credit, so I do want to just kind of spend a few minutes talking about it. First and foremost, what is the minimum credit score? And I know we will get into a slide later that talks about different loan structures, so maybe we'll wait for some of that then. But just in general, what is the lowest one that people can have in order to truly qualify?
580 for VA, FHA government loans, but 620 for conventional.
Perfect. And kind of on that note, on the side note, one of the things that I'll talk about with my clients is if you have any potential credit work to do, don't reach out to some credit company or something like that. Reach out to a lender for so many reasons. But one of the ones that I hadn't realized until I was in this field is that sometimes the most obvious way to take care of our credit is actually not the most efficient. So we can look at our credit and say, oh, I'm going to pay this card down in full. And that may be the solution, but it may also not be. You know, it might be pay off this one medical bill and then ask for a credit limit increase, because then your percentages might change or something like that. And so I just always use that as a benchmark. If someone's like, yeah, I've got some credit repair to do, I'm not ready to talk to the lender, I'll be like, actually, just humor me. I don't know if Bryn is on this call, but I know that was one of the scripts that she had used the other day, is just humor me and have a conversation with my lender, because I actually thought I was in the same boat and I had some credit work to do. And that's one of the strengths of lenders, is they will know what we need to do and what's going to pack the most punch in terms of doing some credit work. And I want to make sure that whatever we're doing, we know is going to have the biggest impact, because between you and me, once that money is spent, it's spent. I've already paid off that credit card. I can't unpay it off. And what if I could have used those funds in a different way? So just kind of food for thought. Keep that in mind. Great advice. Sorry, I'm looking back at the chats real quick. Would you recommend that a client pull their own credit? Oh, that is a great question. And so Allie, I know people often will hear like Credit Karma and stuff. What are your thoughts on that? And is credit annual credit?
Well, Credit Karma and any like credit card company that will give you like your FICO score and stuff, that's great to kind of like have an idea of where your credit score is, but that is never going to be this credit score that we pull. There's so many different scoring models, and even if you're pulling your credit for a mortgage versus an auto loan, it's going to be different. It's just the way that the credit bureaus are and how crazy confusing everything has to be with them. But I mean, it's not going to be way off, but, and like I said, it's a good idea to keep an eye on your score like that, but just don't think that I'm going to pull it and it's going to be exactly the same. And you're going to be like, what the heck?
It's kind of like doing a mortgage calculator online. You never know. It depends on the platform. Cool. Thanks, guys. All righty, onward. So on that note, as they are starting that relationship with you and as we are working towards a pre-approval and pre-qualification, I know you mentioned some of this, but will you just kind of go down the list of the things that you will ask for from the clients?
Yeah, so it again depends on like what kind of income they have, but standard like salary, we'll get last year's W-2, we'll get recent pay stubs. And then obviously just their like ID and 2 months of bank statements, and then their credit reports will pull. So we'll review all 3 credit bureaus and we'll take the middle score, the middle lowest if it's a joint application. If we're looking at self-employed income, then we'll definitely average out the last 2 years of tax returns. If we're looking at somebody that has like commission or bonuses that we'll have to use, then we'll look at an average of the last 2 years with that as well. Now there's sometimes, and Brenda made a good post about this recently, that about self-employed people, there is sometimes an exception. We can use 12 months. It just depends on their situation. So that's something where if you're talking to somebody and they haven't been doing their business for 2 years, or they haven't been on commission for 2 years, it's not an automatic no. Just have them kind of reach out to me and kind of talk it through and see if maybe we can do it based on like the last 12 months.
Exactly. And these are conversations to be had with the lender, but exactly what we were talking about on the front end of this call. This is why we have classes like these and these types of conversations, is so that as we're having conversations with our clients, we can kind of keep an ear out for certain things that we can use as a pass off tool to our preferred lender, vendor, whatever the case may be in that given situation, but also so that we can add a little bit of value and touch on things, because it's always nice for our clients to hear it from multiple people. So for example, when I'm on the phone, I was on the phone with one of my friends that I'd known from college. And so we were touching base, and they'd already purchased a home years ago, and they're looking to upsize in the relatively near future. And so we were having a conversation about life and things going on, but also just talking about houses. And she'd mentioned that her husband had changed jobs, and he's now in sales, and he's got all this bonus structure and all of these great things. And so we're having this conversation, and she eventually kind of asked what that would look like in terms of purchasing. And so I said, well, I'll do a search for you. I'll see kind of how realistic that is in terms of inventory within the area that you're looking for. But transparently, I know you guys are a little ways out. So we'll absolutely talk to a lender about this. But offhand, something that kind of caught my ear is that you mentioned he'd kind of switched from a true support role into sales, which means that he's now commission based. And so offhand, I am a little worried about qualification. I'm sure the funds are there, but in terms of what the lender will need, they will likely need 2 years employment history. So I need you guys to go ahead and just talk with the lender and see what that would look like, if they have a workaround for that 2-year mark, if there's any documentation or things like that. And, just kind of weaving that into conversation so that they know what to expect and they're not blindsided when that timeline comes. And then I'll use that as a pass off tool as well. But it can be a little bit different if you hear that someone's an entrepreneur, kind of write that down. It's a good touch point for us. It shows them that we know what we're talking about without truly taking on that responsibility of seeing what we need in order for them to be qualified. But kind of working it in there, if you go from a sales role to a sales role, that's a little bit easier. Obviously, they love to see one employment history for all of it. But if it's a similar role to a similar role, that can be easier to use than going from one type of position to a completely different type of position. But ask your lender about that. Any questions about any of this so far, you guys? Okay, moving on. So one of the main things that I talk about when I'm meeting with a client, and to Taylor's point, if you guys are having this conversation when we're in a buyer consultation, this is very easy to kind of weave in. But one of the main things I'll do is I'll pull out a sheet of paper and I'll say, let's talk about the money that's going to go into this process and at what point. In my opinion, there's 3 main times during this contract process that you are going to be expected to have some sort of financial involvement. At the time that you go under contract, while you're under contract, and at closing. At the time you go under contract, there's 2 deposits that are due. There's due diligence and earnest money. Earnest money is just more skin in the game. It shows the clients, the sellers, that you are committed to closing throughout the entire process. Due diligence, though, is a non-refundable deposit. It's paid directly to the sellers. It is cashed at the time that it is paid. And it basically is just our time to explore whether we're ready to move forward with this property. It is both a check and a deposit, and it is a time period that we are paying for. During this time period, we are paying the sellers to take their home off the market while we solidify financing and run our inspections. If we walk away for any reason, whether we get the inspection back and it's terrible and the home is falling to the ground, or whether the home doesn't appraise, or whether financing doesn't pull through, if we walk away for any reason, we lose that deposit. So it's incredibly important that we understand that. And I'll go down a rabbit hole talking about what all of those are. Then I'll talk about when you're under contract. You've got inspections to pay for. Your appraisal will be paid for. Now, your deposits will be credited back to you at closing, but the items that you're paying for while you are under contract are your investment towards the property. We aren't getting those back in any way. They're just helping us explore that we're ready to move forward and that we understand what we're getting into with this property. But then the main thing that we want to talk about is the cash that's required in order to close. And that's kind of a broad term, but it's truly made up of 2 amounts: your down payment and your closing costs. Your down payment is going to be a percentage of the loan. So if you're getting a VA loan, for example, that's going to be 0% down. If you're doing a standard conventional, that might be 20%. It is some percentage of your total loan amount. You also have closing costs, though. That is a group of costs that are kind of all lumped into one. It's normally your attorney fees and lender fees. It's also some prepaid items like taxes and insurance that are prorated and gathered in bulk on the front end. So putting those two together and then subtracting the deposits that you put into the contract when you went under contract, that is going to be our cash to close. And so the important thing here is to recognize that even if we have a 0% down program, it does not mean that we are not bringing funds to closing. So that's kind of our general breakdown. But in terms of what that actual amount is, your lender is going to be the one that tells you that. They're going to be able to tell you what loan structure we're going with, and therefore what our down payment will be. They will be able to give you a general ballpark on what your closing costs will be. And from there, we'll have an understanding of how much cash we need to have on hand and have prepared in order to get to closing. Is there anything that you want to add to all of that, Allie?
No, but I think that's like one of the important things that people are kind of looking at when we're going through the whole pre-approval process. And that's why I send them over that 1-page loan estimate type of deal where they can see all of that broken down, and then explain that the deposits do, credit that total bottom line. And it just gives them a better idea of what to expect.
Absolutely. The next class that we're hosting is going to be on buyer consultations, or I guess the class on Thursday is going to be on buyer consultations. So I'll spend a lot more time giving examples and using reference paperwork on how I truly script that in bulk. I don't want to take up too much time talking about that today, but just know if you want to see that, you can jump on Thursday. But in the meantime, when I send out this recording, I will also send a copy of that 1-page that I include in my buyer packet. You'll get the full buyer packet on Thursday, but I'll include that 1-page that kind of breaks down the financing items and what people can expect. Before we hop on over to the next slide, though, 2 things. One, does anyone have any scripts that they would like to share when they are explaining to clients the amount of funds that are needed in order to get to closing or that are needed for this process? There's a ton of ways to do it. Taylor, do you want to share? You're giggling and I see you. You're one of the few people that have your camera on, so sorry, I'm calling you out.
You gave me a look and I was like, oh God, she's going to make me speak again. No, I feel like I handle it like very similarly to like how you explain it in our buyer consultation, whether it's in person or on Zoom. I have a 1-sheeter that's like, here's some costs between going under contract and closing. We obviously hit on the fact that due diligence and earnest money are a variable amount. They're going to change case by case. We go through like the average cost for home inspection, radon, like all the breakdowns of different things that they could see, just to try and like put that a little bit more in perspective. We go over that an appraisal is due like up front once it's ordered, and that a survey is paid for at closing. So we sort of just like run through it. And then whenever I do my like follow-up, once they're pre-approved, I reattach that sheet to that email just to like remind them, here are some things you need to be saving up for. So just to sort of like nail that home a little bit more.
Absolutely. And to your point, there's, we do this every day. Again, I'll say it. We do this every day. This is not an everyday decision for them. So although we have said this in our buyer consultation, I am by no means making the assumption that they have retained that. And so I want to just be putting into writing and reminding them what they can expect to be paying out of pocket. On that note, as we're having that conversation with our clients, it can be very understandable for them to have kind of a shocked look or to panic a little bit because, there's only so much money in the bank. And so if they don't have that money and they are truly ready, they might start thinking of ideas that they can get the remainder of the funds that are needed. And so very often, especially with first-time buyers, that can snowball into a conversation about getting gift funds. So while we're on the slide, Allie, would you mind just explaining what that looks like in terms of your end and different thresholds or requirements for those?
Yeah, and a lot of people do get gift funds, and the biggest thing I tell people up front is if they haven't gotten the gift funds already, the easiest, most streamlined way of doing it is waiting until they find a house, go under contract, and then the donor of the gift funds would wire those straight to the closing attorney. There's just less documentation that way. So if you reiterate that, if you hear that they're getting gift funds, then that would be a great, it'll make everything easier for everybody. But if they have already received the funds, then it's just a matter of getting extra documentation, and that's fine too. They've kind of like broadened who we can receive that from, and it kind of depends on whether it's what type of loan it is, but for the most part, it's going to be any kind of like relative or fiance or something like that. So it's pretty broad, and there's not much of there's some guidelines as far as how much we can receive. Most of the times you're not going to run into not being able to use all of them. So
Yeah. Is it true that they need to be in their account for a certain amount of time or not?
no,
Oh, okay, good.
yeah, they can either have them wire them straight to the closing attorney, easiest way, or if they do deposit them, it can be a matter of depositing them, you know, the week before closing. Obviously, the sooner the better, because we have to receive, we have to show that they're in their account. So transaction history statements, that sort of thing. And that it came from the donor's account too.
Right. And a few things here. One, do they need a gift letter, like a letter explaining?
Yeah, so we'll send out a template gift letter. We fill up pretty much out everything for them. All they really have to do is DocuSign it. And so that part's super easy. And we just send that to the donor directly.
Okay. Also important to note, these are gifts. This is not a loan from a family member that you are then going to be paying back. This is a true gift, something to keep in mind talking with your clients. Allie, this is a question for you. When people get gift funds, does that then wrap in that person partially to the transaction in terms of documentation? Like, does that person providing the gift funds have to provide bank statements or anything of that sort to prove that where they got that money, or is that gift letter enough?
It depends on the type of loan and if they were deposited before the instead of versus sending straight to the closing attorney. So again, that's definitely the way to go if possible. But if they deposit them beforehand, then we would get a 30-day statement transaction history from the donor showing that they were already in the account, that they didn't have a large deposit that we would then have to source.
Yeah, that they didn't get some random line of credit or something like that they're then using. Cremonisa mentioned, as a lender, you need all the receipts for appraisal and inspection, etc. I know the appraisal the lender orders anyway, so they'll see that.
We don't have to worry about anything inspection.
Yeah, we don't get, and the appraisal fee is the only upfront loan cost. So we collect that once we order the appraisal, and then that shows paid outside of closing on the CD, on the final CD as a credit.
Yeah, the inspections don't matter as much. They're more looking at the big stuff. Great question though. So on that note, talking about appraisals, again, I'll kind of run this script through when we're doing our bio consultation class on Thursday, but in general, when I'm explaining this to clients, I'll say, when we get to this point of the process and in my explanation, I'll say, do you know what an appraisal is and how it affects your loan amount? Most of the time I'll be like, I don't know, why don't you explain it anyways? And so I'll say, okay, well, your loan amount is based off of appraised value or purchase price, whichever is lower. So if your home appraises for at or above purchase price, you are good to go. Everything you've discussed with your lender is set in stone, and everything you've discussed previously is the way that it will move forward. That said, if your home appraises for below purchase price, we've got a few options. One, we'll just play dumb. We'll go to the seller and say, hey, it didn't appraise, you need to drop the price. Now, it depends on the situation. It depends on the market. It depends on how motivated the sellers are. Especially in past markets, they were not at all open to that conversation. Because the market is shifting, they might be a little more open to it. But when that happens, there's one of three things that can take place. The sellers will either say, nope, I'm not dropping the price at all. Yes, I will drop the price completely to appraised value, or somewhere in between. I'll drop it slightly, but I won't drop it to appraised value. If there is any difference between your purchase price, what is on your contract, and appraised value, that is what's called an appraisal gap. That means there is a difference. In that situation, we have a few options. Either one, we agree to proceed with the contract at that purchase price or that new purchase price if they've dropped it slightly, but not completely. And we recognize that that remainder is an additional amount of money that we need to bring to closing on top of our down payment and on top of our closing costs. We're bringing this difference. Or we have the right to walk away from the contract, in which case we would lose our deposits and lose that appraisal fee and any inspections that we've done. Now, we will always try to push as much as we can, but everyone has a bottom line. You have a bottom line and the sellers have a bottom line. So they will likely try to make it happen, but if they are not in a rush, or if they don't see the fact that that appraisal came back different, then they might not agree to it, in which case we would need to decide what to do. And so that is a conversation that we want to be having regularly with our clients. This is a conversation that we will have when we're in different homes and taking a look at the homes around it and what we think it could potentially appraise for, so we can set expectations with our clients. But it is a large part of the process. And so I want to make sure we as agents really understand it. So Allie, why don't you just kind of go through the questions that are on the screen and answer those from a lender's perspective. And then as you guys have questions, either raise your hand or drop it in the chat and I'll try to make sure we're weaving those in.
Okay, so what is an appraisal? It is basically the appraiser's opinion of their value. They'll pull comps in the area, usually within the mile range, with similar houses. I always share the appraisal report with you guys so you can see it all, and how they came to that conclusion, what comps they used and all of that. 99% of the time it's going to be required. There are kind of the one-offs where they're putting a large amount down. There's been a recent appraisal, or for whatever circumstances, it comes back through Fannie Mae or Freddie Mac that we don't need an appraisal. And then we could waive that basically. But 9 out of 10 times you're gonna get the appraisal. We will order that and request that to be ordered through our appraisal management company, who deals with, finding the appraiser, rotating through all of that compliance stuff that they have to deal with. And that usually happens as soon as, it's usually 1 or 2 days after you guys go under contract. So once you go under contract, we get everything, and the borrowers sign the initial disclosures. We'll go ahead and order that, and that's when they will get that link to pay that upfront fee online through our management company. It usually is around $650. Again, it kind of depends on the loan type. FHA is like $575. If it's in like a super rural area and the appraiser just knows that it's going to take longer for them to find comps, or if it's just a very unique house, it might be a little bit more expensive because of the extra work that's going to have to be put in there. And we would find that out up front and then disclose that and kind of figure out whether we're going to go that route or keep trying to find another appraiser. The appraiser technically works for the lender. So it says on the appraisal report that their client is us. So technically they can say they can't talk to you or the borrowers or the listing agent or anybody because we've requested it. They're working for us, kind of thing. And that kind of answers that last question. Do we have contact with them? Technically, their contact information is on the report, and there has been plenty of appraisers in the past that are willing to talk to you as much as they can. It's kind of just the same way as, lenders can't disclose all of your borrower's information, but we can kind of like give you a general idea of things. And some appraisers are good about that. Others are just, they're not going to have any contact. And then we'll have to kind of play that, telephone game where we send a message and then they send a message and back and forth.
Yeah, and that's one of the main reasons we also want to continue to harp on this throughout the process, is because out of everything the clients are ordering and paying for, appraisals are their own world, in that appraisers are completely independent from everyone in the transaction. They don't work for me, they don't work for the buyer, they don't work for the seller, they work for the bank. And in essence, they are working to prove that the amount that we are paying for the home is what the home is worth in the bank's eyes, whether that's the same thing as what we see the value as or what the sellers see the value as. Just in the event that anything were to happen and the bank were to take the home back, that they want to make sure that it's worth what they have invested into it. And so we often will not be able to get a hold of them, neither will the sellers. It's a true opinion of value. That said, I didn't know that about if it's further out and it might take longer to get comps, that the cost could be different. So that's interesting to see. Also, the timeline for ordering, when we're talking in our buyer consultation, the fact that you order it so quickly, there's a reason for that. That is really and truly, in my opinion, setting dates for due diligence is centered around getting our appraisals back. And so it can be a delicate dance because we want to make sure we're providing a competitive timeline. Due diligence is one of those top terms in a contract. We need to make sure that it's competitive enough where the sellers don't feel like we're dragging things out, but we also need to make sure that it's long enough for the appraisers to get out there. In my experience, that's typically around 2 to 2.5 weeks. If you set due diligence for that amount of time, it will likely be very tight, but it can likely happen. 3 weeks is pretty safe. But as you get closer to 3 or 3.5 weeks, that can look a little less appealing to sellers. So just something to keep in mind, and setting that expectation with our clients that once we go under contract, I'm going to be doing everything on my end to get all of our vendors organized. I'm going to be talking with the lender and with the attorney. I'm going to get your closing set up. I'm going to organize all of our inspections. Your whole job once we go under contract is to do exactly what the lender says to do. And so very often that's getting them some additional documentation. And then our next step is to order that appraisal as soon as possible. Now, with me saying that, I need you to know that, like I just mentioned, the lender might need some additional documentation from you. And so before they can order it. And so if they're asking for something, you need to get that to them, because we need to be making sure that we're getting that appraisal ordered ASAP, because what I just said, we've got a strict deadline for due diligence. And if it takes 2 weeks or 2.5 weeks to get that appraisal back, and we wait a week to even order it, then we're missing that deadline. And so all working together and kind of reiterating those benchmarks is very important. What's your opinion? Oh, that's a great question. Can you speak on that real quick, Allie?
Yeah.
Let me pause real quick and just say what was said in the chat. They were asking what is Allie's opinion on people leaving a little appraisal or like comp book in the home? So when the appraiser goes to the listing to evaluate the value of it, is it worth leaving MLS sheets or something of that sort that would help prove the value if we feel like it might be hard for that appraiser to find some comps? Sorry, go ahead.
Mm-hmm. And I mean, right now in this market that, I mean, obviously has changed since the last 2 years of craziness. So that was when you're asking 100,000 over, then obviously that kind of comes into play a little bit more. But even now, I've heard from appraisers that they do appreciate it, that it helps them. Obviously, they're going to go and do their own, searches and everything for comps, but it certainly helps, especially if the home is on that borderline of meeting that value or not. Like if you went under contract at list price or above, then I mean, it can only help. And if you get an appraiser that just doesn't bother looking at it, then I mean, it is what it is. You at least put it out there, and again, most appraisers say they do appreciate it.
Absolutely. And just set everyone up for success, especially if it's right on
upgrades, Derek said, and that's a good point too.
Mm-hmm. Exactly. If there is anything that the lender should know. So also speaking on the list side, if you are a listing agent and you are wondering whether it will appraise or not, yes, absolutely. Appraisals are technically a buyer's issue. Appraisals do not justify a price reduction or anything of that sort, but recognizing that if a home does not appraise, then a buyer has a higher chance of walking away because they may or may not have the funds to make up that appraisal gap, then we want to be working to make sure we get the appraiser to get that value as high as possible and as close to that purchase price as possible. So if there are any homes either in the neighborhood or around that we really used as a comp, if there might be some others that weren't so strong, like listing those, like Derek said, listing of features and updates, anything that they've done, any bathroom remodels or anything like that is really important. And also from the list side, putting it out there, this was a multiple offer situation. We had 5 offers that were above list price. That can add a little perspective as well, because then the appraiser knows it was competitive. Now, just because we're putting all this out here, like Allie said, does not necessarily mean that they're going to be going above and beyond. They still need to make it work, but it's worth throwing out there. So kind of to that point, a friendly reminder that appraisers are not here to kill the deal. They're simply here to work for the bank and make sure that whatever number they are providing is something that statistically they can back up. Appraisers do have to hang their license on each report. And so they can't simply throw up numbers just because that's what our contract says. They will try to make it happen and they will absolutely look at that, but they do have to evaluate everything and use that as a benchmark. That said, kind of to Allie's point, it is a true opinion of value per person. And so one appraiser will give a value of a certain amount. And then if a different appraiser came out, they would give a different amount. And so, it's not done by a computer or by a robot. These are humans that are going out to the property and giving their opinion of value. They are doing their research on their own. And so just recognize that, it's just a delicate dance working for our buyers and letting them know, appraisers don't work for us, they work for the bank. And so I need you to recognize that this is what our loan is based off of, but this is not a stipulation of our purchase price. So the purchase price that is in our contract is us agreeing to pay that amount regardless of what the home appraises for or not. It is just the appraiser's opinion of value. And we need to recognize that when we walked in this home and based on the other homes we've toured at different price points and different locations, that we saw the value of this home at the amount that we wrote that offer at. A home is worth what we're willing to pay for it. And at some point we were willing to pay that purchase price for the home. An appraisal coming in at a different number does not change that value. The market is still dictating the value and we were still willing to pay this amount. We still need to try to make that happen. That's just one person's opinion. Some other person from California could walk in and say this home is worth 200K higher, right? We don't know. It just depends on the situation. So recognizing that market status affects appraisals. And then like we talked about, appraisers are the only ones that have no vested interest in this. All right, one word. Is there anything else that you guys like to make sure that you've added in your script or in your conversation when you're talking about appraisals with your clients? Anything you guys want to share? All right. So with that being said,
Kate, Kate, can I just say one thing?
Please.
I'm not sure if you already said it, but something that I was pretty surprised about is nobody picks it. The lender just goes off a list, and this might have already been said, so forgive me, but they just go off the list and just take the next one on the list that they're given. So it's not like they pick or anyone picks.
Yeah, that was changed, I don't know, several years ago, but we used to be able to go down on the list and be like, we want that one. And ask them to go out there, but now it has to be like a rotating thing. And that's why it's moved to actual management company that deals with all of that.
Yeah, because understandably, you're like, oh, well, this one person, he always sees the value. He always tries to make it happen. And there's some others that just aren't as committed to getting us that purchase price. And if not, that's fine. But understandably, there was likely some cherry picking involved, which is why they make it a little more random. Yes. Thank you, Derek. And setting that expectation with our clients, because again, very understandably, if they're paying $600 or $700, they're going to assume that those people are working for them. And that's not necessarily the case at all. So cool. All right. On that note, we're going to go ahead and jump on over to the different loan types. Again, this is going to be something that the lender will totally have a conversation with our clients about. They are going to walk them through all of these options and explaining them and what the costs are and what they can expect out of each of them. But it is very important for us as agents to understand what different loan structures look like, what that means in terms of the amount of deposits they might have to make, what that could mean in terms of credit scores or potential repairs on inspections and things of that sort. So the 4 most common loan structures that we will hear of are going to be conventional, FHA, VA, and USDA. But I'm going to pass it off to Allie and just have her kind of go through each of them and talk about what it looks like, what the different down payment options are, what the interest rates are for different loan products, because that can vary as well. And then there's other little nuances that we just mentioned.
Yeah. So like you said, these are definitely the most common that you're going to see. Usually people will aim to go towards conventional as their number one for many different reasons. One of the biggest reasons too is that PMI will fall off after they get to the 20% versus FHA is for the life of the loan, unless they put 10% down, and then it's for only the first 11 years. And then VA obviously is a go-to if they qualify for that type of loan. If they're in the military, were in the military, or a spouse of, because the 0% down now, they can put funds down, and that will help their funding fee if they have to pay that. The more they put down, the less their funding fee is, which is a one-time closing cost line item. Now, a lot of times the funding fee can be waived if they're on any kind of like disability. Basically, if they get a disability payment, more than likely their funding fee is going to get waived. So that's one of the things that I try to find out right away. So once I do give them that estimate, once they're pre-approved, they'll have a good idea of closing costs and everything. The closing cost for VA is very minimal because we waive the origination fee and a couple other things. So there's only like a few little items that are on the lender side for VA. And a lot of times the attorney will also reduce their settlement fee for VA. So a lot of times you can, it's one loan type that's you can get away with not really having that much on deposit and still closing. The USDA is also no down payments. But that one has a caveat, of course, to just be in rural areas. So they have a kind of a map on their website if you want to plug in an address and see if it qualifies for USDA. They are a lot more particular about any kind of little deposits or anything like that coming into borrowers' statements. So they're kind of just a little bit more particular about things. And then as far as income as well, they're a little finicky about certain things too, like variable income, hourly income. But again, conventional is the go-to. You can put 3% down if you're a first-time home buyer, which means that you haven't owned a house in the last 3 years. Maybe you owned a house 10 years ago and have been renting ever since. You still would be considered a first-time home buyer if it hasn't been the last 3 years. They're going to be the most easy when it comes to looking at the appraisal and any kind of repairs, compared to like VA, where if there's like peeling paint, they're going to mark that as needing to be repaired beforehand. FHA is a little bit similar in that respect, where they're going to note certain repair items that have to be done, because for the appraisal aspect of it, you have to be certified for FHA and VA, and they have to kind of check that box when they're doing the report there. What did I miss?
I think that's pretty well good. And I can kind of circle back to some of them. Just kind of reminding people what all of these are, what the options are. Obviously, the lender will talk through all of this with them, but also to a certain extent, setting expectations of what it will look like while you're under contract, and unfortunately, how different things will be perceived by sellers. part of us being here so you can be educated and knowing all of this, but it's also important. Not everyone will have that same experience or same knowledge. And so it's important that we recognize how different things will appear to sellers and to listing agents. And then that way we can be proactive in terms of how we are negotiating or presenting it for our clients. But, real quick, I think when people are talking about loans, over the past few years, I feel like this hasn't been as big of a deal because there are so many first-time buyer programs, but especially up until those were kind of a thing, I feel like people thought there was just this huge threshold for what you needed in order to purchase a home, and just recognizing with clients, and the more you talk with people, just kind of getting it out there that no, you don't need 20% down to buy a house. I think that's what a lot of people think of. That is what a conventional loan could be if you would like to put that amount down, but even a conventional loan can be dramatically less. It could be as little as 3 or 5% down. And also stressing what Allie mentioned of first-time buyer programs. This is not something I knew until about a year ago, because understandably, first-time buyer sounds like this is your first house ever, and recognizing that's not actually the case. You can have multiple opportunities to qualify for this type of program. Also talking about VA loans. I have this conversation with agents. Amy, I'll get to you in just a second. I'll have this conversation with my sellers when I'm representing them and presenting different offers, or if I'm talking with agents about the offers that they're evaluating, but recognizing that, a VA loan, I think they have kind of this stigma of like, well, it means they don't have any cash or they might not have money on hand. No, not at all. That's not the situation in the slightest, but only certain people can qualify for this loan structure. And if you served our country to a certain extent and you have the option to put 0% down, wouldn't you want to? It doesn't mean that they're not qualified individuals or that it's some loan structure we need to worry about. There are many government loan options that stay on track for closing. And so just kind of recognizing all of that as well. Now, the other thing to just kind of keep in mind that's on the slide, and Allie mentioned, is occasionally you will run into situations where the loan that you are getting has an impact on the property and whether your loan will pull through. And so when we're looking at our appraisal, appraisers and inspectors are two different people. And very often they're completely separate. Please do not send a copy of your inspection report to your lender, but do recognize that if you are getting an FHA loan, or especially if you're getting a VA loan, there are going to be certain things that the appraiser is looking at when they are in the home that to a certain extent kind of cross over a little bit into inspector type territory. The reason being they're a little more particular about the condition of the home and protecting clients and making sure that it is truly livable. And the thing to keep in mind here is what our definition of livable and repairable can be very different than what the lender's is. And it's not because they don't want to set us up for success, but again, because they're protecting their investments. And so when we are getting a VA loan or an FHA loan, being very specific with our clients about pointing out certain things in the home that could cause potential for concern. So in my experience, that's very often railing on decks, or just decks in general. If there's any wood rot, they're just really big on safety. It can also be things like exposed floorboards, or to Allie's point, peeling paint. These are things that we could all look at and very easily be like, well, I wanted to replace that vinyl anyways. Where I most commonly see this is in the laundry room. If someone's just kind of pushed a washer or dryer out of the way and the laminate flooring is peeling up, seeing that in a showing and being like, no big deal. I don't mind replacing that. I'll probably replace it anyways. But recognizing that that is actually an exposed floorboard, and that may come up as a flag on the appraisal. And if there is something that comes up as a repair concern from an appraiser, then that is an item that we cannot get credit for. We have to have the repair for in order for us to proceed with this loan. And so if we are touring a home, first and foremost, with any home, the seller is not obligated to do anything. Hopefully, if it is a requirement on our loan, hopefully they will help us get there, but they aren't obligated to. Yes, it can absolutely impact their ability to sell it down the road, because if one loan is coming back with this, another one might as well. But especially if we are touring a home and in the agent remarks or in the description, it says this is as is. If you see anything like that, you might just need to notify your clients, be like, look, I'm not an appraiser, I don't know, but in my experience, that peeling paint or that hole in the ceiling, that could be an issue, and if there's a hole in the wall, again, we could very easily spackle it or do a little drywall patch. in our opinion, but that might not be enough in order to get the loan done. And we as buyers cannot perform any repairs on the property. The sellers have to do it. So just keeping that in mind. And if you see anything like that, just get in the habit of taking a picture of it and texting it to the lender. Just say, I'm going to, they're not an appraiser either, but they do see these things more commonly than I do. And just putting it out there and getting some confirmation from them. Amy, what you got?
So with the funding fee for the VA loan for a veteran, is that waived just strictly for 100% disabled veterans, or is it any veteran rating, any disability rating?
It's not 100%. So basically, once we get their COE, their certificate of eligibility, it shows on that letter if their funding fee is, if they're exempt from their funding fee or not. So that's one of the first things that get up even in a pre-approval. So we know whether that's going to be waived or not. But 9 out of 10 times, if they're getting any kind of disability income, they're probably going to have that funding fee waived. That's kind of like the first indication. And then we verify that obviously by getting the COE and confirming that it says the exempt.
And that's determined based off of the VA.
Yes.
And what that COE says. Okay.
Yeah.
That's fine. My husband's a disabled veteran, so I only know it from that perspective, not anyone in a different level. So
yeah, so he should be able to like log into his like VA benefits type of
benefits, yeah.
And then he could see that COE and it should say right in like the middle bottom, it should say funding fee exempt or not exempt.
Yeah, I know he is. I just didn't know the different, like if it was at other levels of their disability rating or not. So, and we have a lot of military down on the coast. So
perfect.
Good little market to be a part of. While we're on this, there are ARM loans and rehab loans. I'm not going to spend much time talking about these, but I just want to put it out there that if you run into these, a little overview of what they are. An ARM loan, in essence, is they typically come from a credit union or something of that sort, but in essence, it's a loan that can change rate over time. So you might have a certain interest rate for the first 5 years, and then after that, it has the opportunity to change. Allie, you want to kind of speak on that from your experience?
Yeah, I mean, we're getting a lot of like rehab loans, which can be either conventional or FHA. That's basically where there is so much repairs that need to be done that we can basically get a contractor, like their contract, and then the regular contract, and kind of combine that into a loan. So they're financing the construction cost of whatever they're repairing or and doing in that kind of manner.
So you guys do rehab loans?
Yep.
Awesome. I'm going to have you jump over to ARM in just a second, but while we're on that topic, I just want to put it out there. This is something I feel like HGTV has set some wrong expectations with people. I'm gonna just say it. And not everyone is here to flip some homes. Okay. And so as we're walking into houses, people can have kind of like their eyes are bigger than their stomach type of situation in terms of a property of saying, oh, well, I can do X, Y, and Z, and maybe I'll rip out this wall. And if I can just get a loan to cover all of that, then it'll be easy. And I want you to know that, yes, those things can happen. However, it is quite a process and it is very involved. And to Allie's point, you are combining both your contract and the cost of what it will take to do all of that and putting it all in one, but it's not that simple. You have to get a contractor out to the property. They have to come out and they have to price everything that needs to be done down to the nail of what it's going to take to get this completed and provide that. And so, finding someone that is willing to do that can be a little tricky because they recognize how much time goes into even giving such a quote, but also recognizing, thankfully, I think our market is slowing down some, but recognizing how busy the construction industry is and will you even be able to get a contractor of that sort out to the property to give you that quote can be a little tricky. And recognizing that this does have to be a contractor, like a licensed contractor. It cannot be your dad. It cannot be yourself. Even if you are incredibly handy and it seems like something very simple, it has to be a part of the loan. And so things that you might you might have gone into thinking that you could save money on and be like, well, they'll do all of this, but I'll paint, I'll spackle, I'm going to pull down the wallpaper, or I'm going to do this bath remodel, whatever the case may be. As handy as you are, you cannot be the one that does that. And so just recognizing that and setting that expectation with your clients.
Yeah, very good points. And then the appraisal is based on the after construction is another question I get there.
Interesting. And so what does that closing process look like? So they close on the property and then they
begin construction. And I do always say that the contract to close time period should be probably closer to that 45-day mark versus the 21-30 day for just a regular purchase. Just to allow that time for what we need to collect from the contractor, because there's a whole nother party involved that we have to get stuff from.
And is there a deadline for how long it can take for construction to be completed?
The ideal world is within 6 months after closing. There's been times where exceptions have been made because whatever reason, delays in construction in general the last couple of years.
Gotcha. Thank you. And then jumping back over to ARM loans, just because obviously these aren't things we run into too much, but especially if people are shopping at a credit union, having a 0% down option almost all the time, a credit union is providing a 0% down option, but 9 times out of 10, two things. One, from my experiences, the interest rate that they are providing is the same across the board, which can be great if you don't have the best credit. But if you do have amazing credit, your interest rate is not going to be lower, which is one of the benefits that you can have in different loan products. But the other thing is, very often the products that they are providing is not a 30-year fixed rate. It is very often a loan, an ARM loan. And so although you're putting 0% down, you don't have the security of knowing what your mortgage payment will be down the road. But do you have any experience on that from your credit union days, Allie, or is there anything you want to add about ARM loans?
Yeah, I mean, when you're getting an ARM loan, they should just be aware of all the caps and everything and how much it could increase in the next 5, 7, 10 years, whatever term they have. Honestly, our temporary buy downs are more popular and less of an interest rate than an ARM. And it's kind of similar in a way because it's temporary. So you're buying down the rate to something temporarily for the first year and then the second year, so on. Well, where an ARM is the same kind of way. You're locked in for a certain amount of time because it's adjustable and then adjusts at 2, 5, 7, 10 year, whatever term you choose. But like you said, the rate's going to be typically the same for everybody. And it's just, I don't know, it's more people opt for that 30-year fixed. And especially right now with the opportunity to refi in the next couple of years, sometimes it just doesn't make sense.
Absolutely. And that was a seamless transition because I do, since we're on this slide talking about loan types, I would love for you to talk about two things. One, the 3-2 buy down or whatever our options are, 1 buy down. And I would like to also talk about what it would look like to assume a seller's loan and what that process is.
Yeah, and so the assumption, it depends on what type of loan it is and if whoever, like the seller's servicing, will actually allow that. So first and foremost, that seller needs to make sure with their servicing or servicer what their requirements are and whatnot, and how that looks and how they can offer that. So if you're on the listing side and the seller wants to offer that, that's the first thing that they need to do, because every servicer will have like a different requirements and everything.
And so real quick, just for some perspective, what we're talking about here is, a few years ago, people had some really good interest rates at 3% or even 2.75 or things like that. And so as our interest rates are getting higher and closer to 6, there are certain sellers that are in a position where they are able to provide a loan assumption, meaning you can purchase their balance in essence for their existing mortgage and the interest rate attached to it. The thing to keep in mind here, though, is that very rarely is the property being sold for what that balance is. And so if someone bought the property for 400,000 and now their payoff is 250 and the home is now being sold for 500, whatever the case may be, right? Like you will get a loan for that 250 amount assumed from the seller at their current interest rate, but then you will also have to get a second loan for that balance to cover what it's going to take to purchase a home at its current price. And so we need to make sure that the seller can even do a loan assumption situation, but also recognizing that you are actually getting two loans. So will you speak on that process? And is it truly like two documents that you're submitting, like documentation for both? Is it 2 times the process, I guess?
Yeah, it's definitely tricky because the assumption part of it. So like you said, like if the seller's balance is 250 and they have a VA, FHA, or USDA loan that is an assumable loan, the buyer then would qualify on the servicer's side. So say the seller has it with like whoever, I don't know, not Movement, somebody else, Caliber Loans or whatever. They have to go to that Caliber and see what they require, see if that buyer qualifies for that, assuming the 250. And then once they check that box, they then have to get a second mortgage, and not like a first mortgage, like a second mortgage, like a home equity loan, or somehow to make up that gap. So maybe they have the additional 250 cash, or maybe they have to get it through a loan for just, a home equity with using that house as collateral, which is probably going to be a higher interest rate than just a regular first mortgage. The payment's going to be much higher, that sort of thing. There's a lot to kind of work around, and it has to just kind of make sense. Like, does it make sense to assume the 250 loan at 2% and then get the second loan at 5%? Like, does that make sense? Or do they just get a brand new loan for the full 500 at 6%? So it's kind of just like a matter of figuring out what actually makes sense. And in my opinion, I think it might make sense if they do have that cash for that gap. But it hurts my brain to think that they're going to get like a home equity loan on the gap if it's such a big gap, such a big difference in the contract price and the loan balance that they're assuming.
Absolutely. And then real quick, will you just circle back to like the 2-1 buy down and things like that? Because I know we hear those terms a lot, especially in this market. So just re-explain it one more time.
Yeah. So the buy down option, the 2-1 is the most popular. There is a 3-2-1, and then there's a 1-0 down buy down. Not to like throw so many options out there, but let's just stay with the 2-1 because that's the most common. The buyer's rate is going to be 2% less than current market rate the first year, 1% lower the second year, and then the third through 30 years will be the normal 6% or whatever it is. So essentially their first year is going to be 4%, the second year is going to be 5%, and then they move up to 6%. And in our current market, we feel like there's going to be a refi opportunity in the next couple of years. And some people say 12 months, some people say 2-3 years, but either way, around that time frame where they're might not even touch that 6% altogether.
And does that compare to ARM loans in that your 30-year is based off of whatever that interest rate is when they get to year 3? Like if interest rates go up to 8, could it be 8? Or is it?
No, it would be
30-year
based on what
6?
it is today. Yeah.
Awesome.
So yeah, it's definitely better in that route because it can't go all the way up to whatever. It's based on today's current market rate, which is give or take 6%. And then the other good thing is that you basically get the seller to fund that escrow account to buy down, and you'll never lose those funds. So if you refi or sell the house before those funds are exhausted, it'll pay down your principal balance. So I don't know, I'm a visual person. So if anybody has like, wants more of like the details as far as what that looks like in payments and rates and that sort of thing, and or how much a buy down would cost based on a certain loan amount, then I have an easy calculator where I can just plug it in and shoot it over to you, especially if you're looking at a specific home and wondering like how much seller credit should I ask when we're negotiating. So it does cover this.
Perfect. Yeah, there's a ton to know. It is not our job to know all of it. It is just an opportunity to be on the same page and give options to our clients and also seamlessly hand them off to the lender where they can explore all of that. So thank you. I appreciate it, Allie. All righty. So on that note, I think you've heard us mention it a few times, but there are a number of different types of lenders. I think the ones that we most commonly hear about are going to be the banks or credit unions, but online lenders are also an option. And so as we hear our clients talking about different things or mention who they might have already spoken to, these are great little flags in our head of a reason to kind of address that. Again, it is not our job to tell our clients what to do. It is our job to just educate them and let them know what their options are. And so, speaking about banks, totally understandable. That's where most people start when they're looking at financing because it's what they know. It's where their accounts are. They feel that they have a relationship. It is totally understandable that you would start by exploring what your bank has to offer. Just a few things to keep in mind if we are looking at banks as a lender, though. One, simply because our accounts are with them does not mean our loan process will be any easier or any more streamlined. Just because our accounts are with them does not mean that they will then pull all of the statements, for instance. We will still, as the client, have to submit our documentation and submit bank statements to the lender. So that won't save us any time there. Additionally, bank lenders are often a little more set in their hours and their availability for clients, depending on your relationship with that lender. It can be very hard to get a hold of them. Banks are huge. And so you very much are a number or an account number with a bank as opposed to with a broker or a lender. They're going to be a little more flexible in what they're able to provide. Banks are very set in the options that they have. Lenders and brokers can shop their options and they're a lot more available. So just kind of keeping that in mind. Credit unions are very specific in the products that they offer. They normally have one or two, and that is it. Like we talked about, interest rates might be set for everyone. They are very hard to get a hold of. I was in a group chat with some of our choice ladies the other day. There are like 8 of us in there, and someone had mentioned that they were having a hard time getting a hold of a credit union for one of their clients. And they were asking if anyone had a good rep. And literally every single one of us were like, nope, I have no one. Like maybe one person had someone they went to college with and they're like, I don't even know if they work there anymore. You could try, but it's definitely not the person that you need. It's just like one contact that might have a hope of getting us an answer. So just know with credit unions, they might not give a pre-approval until it is time or until you have an address. And if we are shopping on a night or a weekend, we're not going to have an address for them and we're not going to be able to get that letter. So that can be a little tricky. Also, your client might be speaking to one person, but then as soon as they reach a certain point in the process, it gets passed off to another. There can be a good amount of turnover, both in the people that are in those positions and whether they're hiring or changing those out or throughout the process. And so it can be very hard to get your answers to different questions. And often they will only communicate with the client. They won't communicate with the agent. So that does not help us stay in the loop. If your client is dead set on working with a credit union, just make sure you're setting those expectations with them. Also, talking about online lenders.coms. If you can help it at all, please steer clear for the sake of all of us and our sanity. Nothing is free. Let's just keep that in mind. Even if we're talking about online lenders, if we're talking about new construction lenders, nothing is free. And so if someone is offering a lower rate, you need to make sure that you are getting a full understanding of what your cash to close is going to be and what the fees are associated with that lender. It could be very possible that you are paying for that somewhere. You just might not realize it. You very likely are buying down your rate and they're just using that to appeal to you in terms of what their ask is. So especially with new construction lenders, I don't have that one here, but often a new construction company will say, we'll give you $7,500 in closing costs if you use our lender and you use our attorney. That can be fine and dandy, but are you are you really getting that, or is it being paid for somewhere? So just kind of keep that in mind. Also, online lenders, they are nationwide most of the time, which means that they are not local, which means they do not have in-depth knowledge of our contract. I mentioned this in one of our other classes, and so if you heard it, I apologize, but it definitely bears repeating. I had some clients that were under contract with Rocket Mortgage or something like that years ago, and I had tried my best to persuade them not to do that, but I didn't really have much of a relationship with them. They were a lead I'd gotten online. I was very much still kind of proving my value and building that relationship and trust with the client. And we go under a contract. I've explained everything in depth about due diligence and all that fun stuff. And their lender then told them, well, no worries. If the sellers don't agree to those repairs that you're talking about, you can just walk away and get your money back. And I'm not here to take your money. I wish you could get it back too, but I don't make the rules and I don't write the contract. And I know the contract because I'm a North Carolina real estate agent, but our contract is very different from some other states. And so if an online lender does not know what your contract says, then they can provide some false advice to your clients. And here you have the two largest players in your transaction, your agent and your lender, telling you two totally different things. And wouldn't you want to believe the one that tells you they can save you money and you have less liability? Of course, but that doesn't mean that that's the case. And so it can just be very confusing. It can be hard to add value. It can really mess things up. So just knowing that, and if you're, again, it is not our job to tell our clients what to do. We are here to provide options. And so I support whatever lender they would like, but I strongly encourage that they at least explore those options. It is the largest part of your purchase. So you need to shop your options. Financing is the biggest part of it. So at least know what you're getting into, understand what that means in terms of financing and in terms of the relationship you're going to have with the person that's helping you get to the finish line. And then as they tell you what they're going to work with, explaining the pros and cons of each so that at least they've heard it from you, right? So I think I hit on a lot, but does anyone have anything that they would like to add to any of that? Obviously, brokers, we really encourage because of the relationship, but also because they're able to provide so many different options for people that it can be very specific to the client situation. But any questions about any of that? Or does anyone want to share a story about a past experience, whether with a client or yourselves personally, with any of the other options that might help add perspective as well?
I had an experience a few years ago with a client that got a pre-approval from Bank of America. And then after they further down the road, they were like self-employed. Then they were disapproved. They took that away. And, I've told people, the big banks like that, they don't, you're just a number. They don't really care that as much. And I've tried to discourage people from using big banks like that. They lost their due diligence.
Yeah. And if they're just a number, then they don't care as much about them falling out of contract. Like if it's not easy, then they don't care about it as a client. And that's someone's money. Like I wouldn't want to lose $5,000 or more, whatever the case may be. Thank you for sharing that. Totally valid.
Sure.
Allie, do you want to add anything to any of that as well?
Just to Judy's point, you're definitely a number when it comes to those big banks, and then online lenders, they don't care about the buyer. They don't care about the agent. They don't care. They're just a number and they just keep it going. So local, we have reputation to uphold. So, we are going to do everything we possibly can in the upfront to make sure that that doesn't fall apart in the back end.
Yeah. And I know we joke about it, but one of the things that we say about local lenders is like, anything happens, I know where to find you.
Right.
At a big bank though, yeah, I can show up at a branch, but like they're going to pass me off or say, I need to call this number or take some accountability. It's a lot easier to pass things off and provide a less than ideal situation when you don't have to take accountability or have a personal approach. But that's what we want. We want a personal approach and we want to make sure we're treating each of our clients with diligence and care. So awesome. Thanks for sharing, y'all. So I think this is kind of where I had started when I was talking about an intro, but this is more so what I'm talking about. So once you go under contract, what does that process look like? I kind of have it outlined here, but you want to just kind of read through it and let me know if there's anything I'm missing or anything you want to share. Taylor, she knows where Allie lives. Do you have any trouble? Just kidding.
Yeah. Well, if anybody knows how to use Wake Up, they can find me. But anyways, yes, everything looks good on here. That's about it. I mean, we send the pre-CD before we finalize the numbers with the attorney. That's the last thing. But like I said, Movement does things super quick. So as soon as we submit it to underwriting, they have a conditional approval within 24 hours. So
awesome. So in essence, when I'm explaining this to the client, I'll say, okay, awesome. We've got our executed contract. Here's what's going to happen. I'm going to start by sending a copy of that contract to the attorney and to the lender. The attorney will organize your closing. I will let you know when that is. Let me know if there's a certain time that works for you. Other than that, we're just trying to get on their schedule for that day. The lender is going to work on their end. They're going to do everything they need to do on the back end, and they will let you know what documents they need. As soon as they make a request for one, please go ahead and submit it. They're going to ask for a number of items, and they very possibly will ask for the same thing twice. So I always recommend, Mr. Buyer client, that as you're doing all of this, as you're sending stuff to the lender, just go ahead and proactively make a folder on your desktop and just put anything that you are sending to the lender in there. That way, if they need another copy of it, you know where to find it. You might have to go back in and re-download the most updated bank statements, for instance, but anything else, let's go ahead and add to that file. They will order your appraisal. I will order your inspections. And then as we get further through the process, like I said, they'll continue to ask for things. As we get towards the end of the process, they are going to issue what's called either a conditional or unconditional approval. If it is an unconditional approval, it means that we are good to go and we are headed towards closing as long as nothing changes with your financing. So please do not go out and buy a new car. Please don't buy that furniture that you've been waiting on, even though it may take 8 months to get here. I apologize, but we need to make sure we're keeping everything in your finances the same as what your lender is expecting and has approved us based on. If they issue a conditional approval, it means that we are good to go. There are just a few more things that we need to take place and get handed over to them or have done in order for that full approval. So whatever it is that they need, go ahead and get that to them. That could be a gift letter. It could be a letter of explanation for something as simple as your business name. You know, they will tell you what they need. Go ahead and get that to them. And then as soon as that is approved, we will get an updated approval. So once our loan comes out of underwriting, they will coordinate with the attorney to make sure that the lender and attorney have matching numbers, and then they will communicate with us. Now, the thing that we need to kind of keep an eye out for is 3 days before closing. No later than that, we will need to receive a copy of our preliminary closing disclosure from the lender. According to nationwide lending regulations, we have to receive a copy of that no later than 3 days before closing. Not only must we receive it, but we must acknowledge receipt of it. So I will keep an ear out. I will put it in my calendar. I will put it on your calendar as well. And then as we start to approach that, I will be touching base with the lender to make sure we are on track to get that out in time. It is most commonly business days. So we need to make sure that we're kind of buffering in for the weekend. If by some chance we miss that date, we will have to extend closing. And I know you have movers scheduled. I don't want us to have to change anything. So I'll keep an eye out. Just know that as we're approaching that timeline, you need to be reaching out to the lender and asking them how they need us to acknowledge the receipt of it. It could be as simple as us just opening that email. They might have a trigger on their end, but very often it is an electronic signature. But whatever the case may be, make sure you understand it and that you do it that same day. Now, these do not always go out during business hours. So if we have not received it by 5 p.m. that day, fret not. We could be receiving it at 10 o'clock or 11 o'clock, as I know that is not ideal, but it can happen. So we'll keep an eye out on it together. Very often I am copied on it, but I might not be if it comes through their system. So please let me know when you see it come through, just so we can all be on the same page. And then right before closing, you will wire those funds once we have matching numbers. Now that is preliminary. It is just to get that in front of you and get you an estimate. It is not final. So if anything looks off, fret not. We are not signing to acknowledge that we are locked into these numbers. We are just signing to say that we've gotten this document. So it will be finalized as we get to closing. running into a few questions. I know a lot of people think that the loan process takes forever, and it's just because they have a lot of regulations that they need to meet, and they want to make sure that they are processing everything correctly. So it is common that we will get some questions from the client of what's taken so long. Well, you know, you're not the only client, and they have a lot to review. They need to be doing stuff on their end. So that could be the case. It also, you know, transparently, it could be you, Mr. Buyer. Like, we might not say it right, but if the lender is asking for something and we've taken 5 days to get it to them, what's taking so long could have been the fact that it took you forever. But, you know, that's harder to say. So the more we can say it on the front end, be quick in what you are getting to them, that will help expedite the process. Taylor's cracking up. Anything else you want to add to that, Allie?
No, I know why she's laughing, because we had a closing last week and the buyers just didn't want to give us anything until like the very last minute, but we just still closed on time. So
Whoop, whoop. Yeah. I mean,
but
let's be real. None of us want to do it, but we have to. So,
but there is a lot of things that are happening in the back end that it does feel like nothing's happening, but things are happening. And, you know, working with the attorney on certain documents, and the borrower's employers, and getting verification of employment, that can take some time depending on, you know, what's going on. I mean, there's so many little things. The homeowners insurance, people are shopping for homeowners insurance in the background. There's just so many little things that are all happening, but sometimes it seems like nothing's happening.
that's true. The ultimate statement of no news is good news. We will let you know if something's wrong, but in the meantime, they're just working on stuff on the back end. That's very true, though, with the employment letter thing. Speaking from personal experience, especially hospitals, for whatever reason, they can be very slow to get verifications of employment out for their people. So if you know that someone works at a hospital and they're going to be shopping, just kind of proactively tell them that. Be like, you're going to likely have to do some nudging because your lender is going to need that. Cool. Thanks, Phil. All right, here's some other common questions. To Judy's point, what could cause someone to get declined for a loan or to have their approval withdrawn after they've already been approved, aside from the bank themselves or whoever it is just not simply doing enough research? But what could happen in order for that to take place that we should be proactive in telling our clients to avoid?
There is certain things that people can avoid, like if they get fired within that process. There has been one person that decided to quit their job about a week before closing, and somehow I convinced them to go back to their boss and get rehired because they're not quitting their job yet. So that worked out, but obviously don't change any kind of employment or anything really. It only happened to me personally one time that this woman was self-employed, and the whole business tax returns and everything, we couldn't get the numbers to work. It was a lot, and even the borrower understood and had to go to just like a local community kind of bank. So they were able to still close, so that worked out. But if you have a good loan officer that is looking at everything up front, there really shouldn't be many reasons why they're going to get declined in the back end.
Right. Most of the time, if someone is no longer approved, unfortunately, it has to do with the lender. And that's why, as much as we hate to do it, no one loves providing stuff for financing. And, you know, there's never a fun time to do it. Let's be real. But providing as much on the front end as possible. Like if we can only send in 2 documents once we're under contract because we've submitted everything already, like that is the ideal situation. What about if someone gets married while they're under contract? Does that play a role in anything?
Not necessarily married, but if they change their name, then we would have to repull credit in the new name and kind of get a new signatures out for the application and that sort of thing. So nothing crazy, just something like additional that's going to take some time to do and to get their signatures and whatnot. But that wouldn't be a game changer as far as that's concerned. We obviously want people to wait. Every time somebody's like, yeah, I'm engaged, I'm like, so when are you getting married and changing your name? Because let's do that after the fact.
Fair enough. Thank you. All right. And then these are just some obvious questions I'm sure you've heard, but just so we've said it here, why do lenders ask for the same document a number of times? And is it truly the same document, or is it an updated version of that document?
It's usually because the borrower will give us a screenshot of like their pay stub or bank statement or something, and underwriting will not accept anything that's like marked through or not like an actual like PDF format. We can't take a screenshot of your phone and accept that. It has to be like the full document. A lot of bank statements have a page in the like, pages 1 through 5, and page 5 is blank. So we don't get that, but we actually need all pages to verify that that page is blank. So it's usually just because underwriters are so specific in the documentation that we need.
And also, last question, why can't they use common sense?
Yeah, that would be nice. But again, they are so black and white, and to, Derek's point earlier, like it's just, they have regulations and guidelines that we have to follow per Fannie and Freddie. And it's not like a state employees credit union where they're making their own guidelines and it's all portfolio loans, where they can maybe possibly make some exceptions. It's really just, if it's not on the guidelines, it's really hard to make that exception.
Yeah. And just reminding people that things change over time and new guidelines and rules are put into place based on past experience. And so because of everything that happened during the last Great Recession, there are a lot more rules in place, which, as painful as they are and as much as it adds work for us, it really helps solidify that we're doing everything and setting you up for success. And so please know that these regulations and these processes are not specific to you, and it's nothing to be offended by. This is a standard practice that's across the board. So things like providing proof of funds for large deposits, for instance, that's across the board. It doesn't mean they don't trust you. It just means that they need to understandably source where funds are coming from. That's kind of one of the most common ones that I've seen in the past. Are there any questions that you guys have received from clients that you think would kind of fall into this category of questions that might seem a little obvious, but also a little hard to answer? Or if there is one that you kind of used as an example when you're talking to a client and forever change the script of stuff that you make sure you're saying to people. Feel free to unmute if you would like to add anything. Real quick, though, I want to, on that note, put out there, give Taylor some more praise that one of the things that you include in your buyer expectations and rules is stuff like this of like, don't quit your job and do not go out and buy X, Y, and Z, Also just kind of being proactive in explaining to your clients as they go under contract and as they get to different steps to remind them of these things. Like, don't wait until we're further, like as we get closer to closing, to remind them not to buy these things, especially if we're looking at new construction where they're going to be under contract for a year. Understandably, they need a fridge for when they move in. But if they are doing that, they need to make sure they are checking with their lender first. I'm not saying you can't do it at all, but you definitely need to check with your lender. Very likely they will tell you to pay cash for it if you can, not to use your credit or change your credit in any way, whatever the case may be, but just setting those expectations with your clients of literally, if anything is over a few $100s, just be touching base with your lender just to be sure. Because the last thing we want to do is risk everything for something that could have been avoided. So on closing, as we approach all of that, we talked about the 3-day guideline. As we get closer to closing, those numbers will then be finalized. Normally, that means you are then wiring the funds either the morning of or the day before. As soon as those numbers match, you are wiring those funds to the attorney, reminding your clients that I will never be sending those numbers. The lender will never be sending those to you. All wire instructions will always only come from the attorney. Wire fraud is very real. And once those funds are gone, it is near impossible to get them back. And so if you ever receive wire instructions from anyone claiming to be me or a lender or any other person, disregard them and always call the attorney to confirm. Once that money is wired, it then goes into the attorney's account. They will hold it. Depends on the lender as far as what the next steps are. Typically what will happen is you will go in, you will sign everything. The attorney will then send a copy of the signed documents to the lender for their approval. Sometimes the lender will proactively provide their side of the funds. Other times they will wait for a copy of those documents to come through with the buyer's signatures after closing, and then they will fund the loan. It just totally depends on the situation. But your client will be bringing their down payment and their closing costs. The lender will be providing the funds for the loan amount. And so combined, we will need those together to close. And so it is not until both sides of those funds have been received and all parties have signed, they will then submit your closing documents to the county for recording. And once it records, then it is truly yours, which obviously we'll talk about more when we work with buyers, but and we talk about this process. But friendly reminder, if your clients are setting things up for moving, to buffer in a few hours. Allie, you were shaking your head a few times. What does Movement Mortgage do in terms of funding? Do they wait for certain benchmarks?
Yeah, as soon as we get clear to close, we fund the loan. So their funds sometimes are there before they're even there. A lot of lenders do require the closing package to be sent back to them. They look at it to make sure everything's signed and then they fund, but we go ahead and proactively fund right away.
Which is incredible, because to your point, not all lenders do that. And there's nothing worse than your clients really pushing it up against the line and really needing to be out of their current house. And they've got their moving truck scheduled, and for whatever reason, the lender just takes forever. And, you think that everything is en route, but you don't realize the lender hasn't sent the funds, whatever. It can make for a tricky situation. So as you are approaching closing, always get in the habit of speaking with the lender and just saying, hey, by the way, can you tell me what the process is for you guys as lenders in terms of when the funds will be to the attorney? And then again, that way you're setting the proper expectations with your clients in terms of when they will be getting keys. It's hard to truly know, but at least we can prepare them. So a few things to remember as we are preparing our clients. First and foremost, we are going to be telling them to, by all means, stay current on all existing accounts. Even if you're selling your house, be talking with the lender, talk with the bank about what payment to be made, what payments need to be made, whether you should pay that last mortgage payment or whether it will be reduced after you close, whatever the case may be. Like, stay current on all of that, especially your standard stuff. Continue to use your credit as you normally would. So like we talked about before, don't pay off all of your credit card all at once while you're under contract. Or, if you have one item that's always drafted from that account, just keep that going. We don't want any of your accounts to dramatically change. We want our credit score to stay the same. We're also going to be keeping a copy of all the documents. Like I talked about, they're going to be requesting some more copies of them. So just keeping all of that organized for sanity's sake alone, but also for ease of resending them. Keep all of that in one place. We also want to provide a copy of documentation for the sale or lease of our current home, especially if we are purchasing a second one and we haven't yet sold ours, or if we're going to be leasing it. That can be a little tricky. And so getting your clients to recognize that as well. If you live somewhere and you're looking to upsize, that is a liability in terms of the amount of expenses we have on a monthly basis. And so recognizing that we might proactively need to go ahead and get your house up for lease and secure a tenant and then proceed, but having that conversation with the lender to see if we need to do that or not, knowing that it very possibly could take place. Because again, debt to income on a monthly basis can be affected by something like that, but talking with the lender to see what they need. We are going to keep in contact with the employment. We want to make sure that nothing changes in terms of employment or marital status if we can help it. Like we talked about, there's going to be some situations that you can't avoid if a company is doing layoffs or something like that. God forbid it takes place while you're under contract, but at least proactively setting it out there to our clients that we should be keeping everything the same. Taylor said, can we hit on the double appraisal for new construction or just before we wrap up? Yeah, absolutely. You want to just chime in and say specifically what you were asking about?
Sorry, I couldn't find the unmute button. So I know like when I first started out, like I didn't realize that you did you have to do like 2 appraisals once you get the official CO. So I feel like I would know very little. So you need to explain like how that works. Sorry.
Yeah, for when you're doing new construction, you usually, now you can just do 1 appraisal, but that's kind of waiting too long and it just might delay closing. So typically you do 2 appraisals. The initial appraisal will be done around once the drywall's up. and it'll be subject to completion, the value. So assuming everything is completed the way the plans and everything have been presented to the appraiser will go back out to the home. Usually, I mean, it can be even like the day before closing because they're really quick to do the final report because it's only like 2 pages, just to check that box saying everything's done, everything's complete, and the value is as stated previously. And that can be right before, right after you get the CO. Depends how quick that builder is to get the CO, but we have to have the CO before closing for sure.
And just talking about new construction, because I should add a slide about it. Thank you, Taylor. But with new construction, as we know, it's quite a process in terms of length. And so there's only so much the lender can do on the front end. Obviously, they're going to be preparing the file. We're going to send them a copy of the contract and they're going to go ahead and start things. But in terms of initiating that appraisal, in terms of doing a final credit pool, things like that, they're going to want to wait until we're further down the line. Normally, once we start to hit the drywall phase, or even once we start to hit the cabinet phase, which means we're normally about 8 weeks out, we want to make sure we recognize that even though we've been under contract this whole time, very often the lender is just kind of sitting tight for a second. So we need to make sure that we raise our hand and touch base with them as we get closer to that timeline, because they're still going to need like a month or so to get that file in order. And if we forget to tell them, even though we're driving out to the property regularly, they're not going to know that we're getting closer. Now, a good lender is going to absolutely continue to check in, but they also can't read our mind. And so letting them know as we approach all of that so we can set our clients up for success, because there would be nothing worse than your client being under contract for 6 months and then it gets pushed to 8 and 9 and whatever. And then finally they get the go ahead and we get 2 weeks out from closing and realize that now there's going to be a delay on our part because we didn't let the lender know. And by the way, as unfair as it is, builders can delay as many times as they want, but as soon as we as the buy side delays, then the buyer is charged per day. So thank you for asking about new construction, because that is very important, and it's easy to kind of fall off because we aren't doing anything for a while and then we're finally in the thick of it. But remember that lending needs to be a part of that. Awesome. It seems like it would be obvious if we're talking about keeping our credit the same and not doing anything to change it, but don't apply for a new credit card of any kind when you're going to Sephora and you're spending $300 on your makeup and stuff. That 20% might sound nice, but please, for the sake of your brand new home that you worked so hard for, don't mess it up now. Just kind of reminding them, like I said, just have a little checklist, include it in your buyer packet, include it in your email once you have a new client, just kind of setting these expectations with people. Like we talked about, don't pay anything off dramatically, don't make any large unexplained deposits, and don't transfer any assets, even if it seems like it would be very simple. We're just moving something from one account to another. Make sure you're talking with your lender about that. And if you need to be transferring a large amount, I personally have 2 different checking accounts. I use one of them almost like a savings account, but just for easier access. So I just don't even access it. I forget that it's there, but occasionally that's the one that I'm going to be transferring large stuff from. So if I know I'm likely going to be doing that, then once I go under contract, I'm going to touch base with my lender and tell them, hey, if I'm going to be moving $5,000 over, so I help cover my closing costs, should I do that now or should I wait? And whatever the case may be, but touching base with your lender about any of that and not doing any of it at the last minute in large chunks. Don't make any job changes, please. And then, like we just said, don't make any large unexplained deposits. So on that note, I know we've talked for quite a while. I appreciate everyone's time. Real quick, Allie, 1, does anyone have any questions? And also, B, would you mind sharing what current interest rates are? I know they change every day and it depends on the person and the situation, but in general, where are we currently?
In general, we're right around, give or take, 6%. And that's for all loan types, all people, but it definitely depends on how much you put down, what your credit score is, and what type of loan you're doing.
Awesome. You guys have any questions for Allie or myself while you're here? Well, if you think of anything, you guys just let us know. I will send out a copy of the recording and the slides later today. In that, I will also include an introduction to Allie and her contact information. So if you think of anything, or if you have a certain client in mind that you want to ask some questions about, or if you want to make an introduction, then you can do all of that. Or feel free to just hit me up if you have any questions. But thank you guys so much for your time. I know it was a long class, but hopefully you guys were able to have some takeaways and provide some additional information to your clients. Again, it is not our job to know everything, but it can be really nice to have some other perspectives and setting people up for success. So you guys just let us know if you think of anything. Allie is local to Raleigh. Thank you for asking. You guys just let us know if we can do anything. But in the meantime, you have an amazing day. I appreciate your time. Thank you, Allie, also for doing
Thank you. Thank you, everybody.
Bye, y'all. All right.